Hi everyone, welcome to this time Scrolling Finance. Well, last week everyone paid attention on the parade and no economic data came out. After that day, the expected recovery of China's bonds market didn't show itself. The bonds market had an unexpected weakness. So as always, let's have a quick review of the bonds market, then check out the details part. Alright? Total bond yields curve was flatter than the week before. Yield of 3 years term went up 1 basis point. Yields of 5, 10, and 30 years terms went down 2, 1, and 2.5 basis points. If we compare to the one of December 9th last year, the curve was still twisted and flat. Yields of 3 and 5 years terms went up 10 and 3 basis points. Yields of 10 years term went down 9 basis points, and the 30 years term almost unchanged. The spread between Chinese treasury bonds and commercial bank perpetual bonds was at the same level, with 5-year spread was 55 basis points. About the actions of investment agencies in last week for short and middle-term bonds, big banks and policy banks bought 54 billion yuan together. City commercial banks and joint stock banks sold 115 billion yuan together. And for long and ultra-long-term bonds, funds bought 22 billion yuan, whereas city commercial banks and securities companies sold 29 billion yuan together. Next, let's check out the details part and see what happened last week. So, in terms of fundamentals, no economic data came out. The most important indicator was the performance of China's stocks market, which almost hit 3,900 points on Monday, then decreased more than 100 points within 3 days after that, and finally increased to above 3,800 points until last Friday afternoon. Meanwhile, China's bonds market has experienced an unexpected weakness. The fundamentals didn't show any clear sign of recovery, and the stock-bond seesaw effect became weird. The bond yields didn't go down as China's stocks market performed weak, but keep the bad habit when the stocks market goes up. It seems like the bonds market was more sensitive to the negative vibe. But if we look forward, there isn't any new and strong demand-side policy to pair with the anti-convolution policy, and the bonds become more valuable after several turns of adjustment. So from long and ultra-long-term view, it is starting to show some value to buying, although it is now in a space with high fluctuation. Plus, the fundamentals is still weak, so we can take the enlarging duration of our bond position into consideration. For funding conditions, last week the funding condition was in an environment with cheap price but tight for volume. The PBOC totally squeezed 1.2 trillion yuan liquidity last week, but the financing price has kept low around 1.3% for overnight. So the funding condition stays loose and won't be a problem in the near future. Then, from short and middle-term view, bonds market is fine. We can take more short-term bonds as a buffer. Then, what should we pay attention next? First, the performance of the stocks market. Personally, I don't think the breathing upward will last so long, but now it is in a positive trend indeed. Second, is there any new strong demand policies? It is important. The anti-convolution policy can't drive China's economy up only by itself. Third, monetary policies. Either fiscal policy or economic recovery needs loose monetary policy to support. So maybe there is more space for monetary policy to do something. And don't forget the economic data. Let's see the extent of economic recovery through this. About bond investment strategies, as we always said, patience is everything. Don't put too much stake on this phase, but we can buy some long duration bonds at a small pace when it adjusts to a high level. Now the bonds market doesn't live from the fluctuation space, so be careful. It is the hardest time to win some trading gains. So as always, if you want to know more useful finance information about the Chinese bonds market and the economic situation, please like, share, and subscribe. I will always be here, share my understanding, experience, and waiting for you. So bye guys, until next time.